Hi, everyone, and welcome to the Strategy Skills Podcast. If you're listening to this in iTunes, remember that there's a video version of this in YouTube, and it's probably going to be a little bit better to watch it there because some of the information is probably best viewed than just listened to. But I'm going to do my best to make sure we cover everything so you don't have to listen to it on YouTube unless you find it useful to use the videos. Now, the Strategy Skills Podcast, to a large degree, covers everything we have in the Corporate Strategy and Transformation Study that is available to insiders. So this is a more lighter version of that very detailed study with much more videos. And today's episode, I'm going to talk about not just value chains in a lot of detail because I've covered that before, but I want to talk about what level of detail you need to have in your value chain. Because the word value chain is thrown around so often, it's very hard, I think, for people to know what it means when you hear the word value chain. Now, this is just one rendering of the many analyses we did in the version of the study available for insiders, right? But the bottom line is that if you're advising a client on where they want to invest in the long term, and essentially all business advice is where do you invest, right? Whether you invest in X, whether you invest in Y, but it's always an investment decision. If you're telling a client where to invest, you're ultimately telling them where to invest in the value chain. You're saying invest here because we think the competition will be least, it's growing the most, and this is where money will flow in the future. So essentially, whether you're aware of it or not, you are telling a client where to invest in the value chain. If you tell a client, you know what, we've got to bring back high-end manufacturing to the United States, you are telling a client to go upstream into manufacturing in the United States. You're telling them to go up the value chain. That's a value chain investment decision. You may not even be aware of it. If you tell a client to invest in call centers, you're telling a client to go downstream just before they get to consumers to invest in that portion of the value chain. If you tell a client, you know what, there's almost no value in manufacturing anymore, we've got to outsource it, you're telling a client to exit a portion of the value chain. You're making a value chain decision. So almost every decision in business is a value chain investment decision. Now, the exhibit here shows you the value chain we built for a power company. And here you have vertical columns designing a power station, transmission lines and distribution lines, building it, operating it, and maintaining it. So you've got 4 columns with the 4 segments of the value chain. Then going horizontally across, you've got 3 rows. Generation, transmission, distribution. What that means is that there's a generation part of the design portion of the value chain. There's a generation part of the build portion of the value chain. And then what we've got here are arrows, which says that based on what we think is going to happen, this is where we think value is going to flow. Here's an example of this. There's a big push around the world to move away from coal-fired stations to CCGT, which is a type of a gas station. The thing with gas stations is that they are cheaper to build, faster to get up running, but because you run them at a very high capacity utilization, the maintenance costs go up because they suffer from more wear and tear. So what that means is that if you shift from coal to gas, the amount of work in the build portion, the amount of money you spend on building the power station decreases, but the amount of money you'll spend on maintaining the power station increases. Another example here is that if we say that we are going to run the reserve margin at a lower value, what that means is the reserve margin is the amount of capacity in the power stations you're not going to use. You have that for a reserve as a safety measure. If the country decides we're actually going to have a lower reserve margin, that means you're going to use more of your power station, which means that you run them harder, which means your maintenance costs go up. So here you can see an arrow showing that operating costs go down, maintenance costs go up. If you move from standardized to non-standardized designs, then your design costs go up. But if you move from non-standardized to standardized designs, whereby you're not investing so much in designing, then your design costs go down and your building costs go up. So you've got to decide where the market is going, what regulation is coming up to figure out where profits are going to go. And then you've got to tell your client to invest here, right? If you run a clothing store and, well, look at Victoria's Secret, right? They're taking a bit of a hammering in the market, and I don't think they're going to do very well in the long term. I think they will go bankrupt at some point, right? But if you're advising Victoria's Secret, double down on those padded bras, double down on the Victoria's Secret show, I mean, how bad must a company's products be that there are fewer people watching these women on television? I mean, how bad must the product be, right? So you're always making these value chain decisions. If you tell them, double down on the show, make it the biggest extravaganza you've ever seen for the Victoria's Secret show, you're telling them, invest downstream just before the point of interaction with the consumer. You're telling them, go all in into the value chain downstream. If you tell them, look, we don't have to worry about design. It's really just about distribution and marketing. You're telling them, stop investing in design. And again, continue moving downstream into distribution. So it's always a value chain decision. You need to be thinking that way. But here's another example. This is from the second edition of Succeeding as a Management Consultant. This is another rendering of a value chain. And as you can see, it simply shows the steps in manufacturing gold, right? There are no numbers here. We can put the numbers in later, but the point I'm trying to make here is that when designing a value chain, design it for the purpose you want to use it. Not every value chain needs to look like this, and this is actually a simpler one. We could make this power one much more complicated, but being more complicated is not useful. This discussion about where value is shifting is really the reason why executives are hiring you. But you can see in this value chain rendering, in Succeeding as a Management Consultant, in the second edition anyway, it's a much simpler version. All we want to do here is we don't want to understand where profit is flowing. We just want to see what are the steps in extracting gold so that when we model this, we model the right steps. So a value chain analysis is not a standard term whereby if someone comes to you and says, do a value chain analysis, you've got to figure out, why am I doing this value chain analysis? What are you going to use it for? What is the question you want to answer? Then you've got to figure out, okay, based on the question you want to answer, how do I design this value chain analysis? How do I render it? Because if you go into lots of details, putting in numbers and where profits are going in the industry, where competitors are making investment, where supply is going, how are suppliers ramping up their plants and so on, you may end up producing a value chain analysis that does not help you answer the question you are being asked to answer. And should that happen, then you've basically wasted a lot of time. A value chain analysis, in summary, is not a standard piece of analysis whereby it means the same thing everywhere in the world. A value chain analysis is one of those things that could mean anything. It could be in something as simple as actually listing the steps of the value chain as we've done here, or as something as detailed as plotting where profit and capital investments are going to flow, not just today, but over 10, 15-year horizon. So if you're going to do a value chain analysis, make sure you figure out why I'm doing it, what question it's going to answer, and then build only that level of detail and complexity to answer the question you're being asked to answer. And what you should do is then tell the person, okay, you want to answer this question. To answer this question, I can build this value chain analysis, and it's going to be this simple. Are you sure this is the level of detail you want? What you'll most likely find is the person will then realize the question they're asking is wrong. They'll adjust their question, and your analysis will change. Now, if you'd like to see more details on this and other similar studies, you can get advanced preview episodes if you go to firmsconsulting.com. That's firmsconsulting.com, and you register for free or put in your email address, and we'll be able to mail you some of this. And if you have any questions about value chain analysis and so on, we do look at what readers are giving us and viewers are giving us. Put it into the comments, and if it's something that we think needs to be answered in a follow-up episode, we'll make sure to do so.